Did you know that one simple investment can give you ownership in over 500 companies instantly? By the end of this video, you'll know exactly how to evaluate any ETF before putting your money in. Let's dive in. Hello everyone! Today we're exploring ETF, Exchange Traded Fund, and the 5 critical factors you must examine before investing. Throughout this video, I'll use a real-world example to illustrate each concept. But please note, this is for educational purposes only and not a recommendation to buy or sell any specific investment. So, what exactly is an ETF? Think of it as a basket of investments, stocks, bonds, or other securities, all packaged into one unit that trades like a stock. ETF combine the diversification of mutual funds with the trading flexibility of individual stocks. For example, let's look at the Vanguard S&P 500 Index ETF, ticker VFV. This single fund holds 505 different companies. Instead of buying Apple, Microsoft, and Nvidia separately, you own pieces of all of them through one ETF. That's instant diversification across the entire US large-cap market. Where can you buy an ETF? It's simple. ETF trade on stock exchanges just like regular stocks. You can purchase them through any brokerage account, whether with a traditional bank, discount broker, or robo-advisor platform. In our example, VFV trades on the Toronto Stock Exchange. As shown in the fund documentation, it traded an average of 911,937 units daily over 12 months. That's excellent liquidity. You may pay brokerage commissions when buying and selling, though many brokers now offer commission-free ETF trading. Before diving into the 5 key factors, understand this crucial concept: NAV, or net asset value. This is the actual value of all investments held by the ETF, divided by the number of units outstanding. It's the true value of one ETF unit. Here's the interesting part. ETF have 2 prices. The NAV is calculated at each trading day's end, representing what the holdings are actually worth. During trading hours, ETF trade at a market price determined by supply and demand. Looking at our example fund's documentation, over 12 months, the market price ranged from $122.55 to $155.96, while NAV ranged from $122.50 to $156.03. Notice how close these numbers are? That's ideal. The fund facts show an average bid-ask spread of just 0.02%, meaning high liquidity, and you'll trade very close to true value. Now let's get into the 5 critical factors you need to examine before purchasing any ETF. First, understand the ETF risk level. Every ETF receives a risk rating from low to high. In our example, as shown in the fund facts, this ETF is rated medium risk based on year-to-year return variations. Don't stop at the risk rating. Examine the volatility metrics deeper. The fact sheet shows a standard deviation of 11.76%, indicating how much returns typically vary. You'll also see beta at 1.00, meaning it moves exactly with its benchmark, the S&P 500 index. The R-squared of 1.00 confirms that 100% of movements track the benchmark perfectly. Check the worst-case scenarios. As shown in the fund facts, the worst 3-month return was negative 13.68%, turning $1,000 into $863. Ask yourself, can you handle that short-term loss without panicking? For detailed risk information, always review the complete prospectus and risk disclosures available on the provider's website. Second, examine the track record. Look at performance across various time frames. In our example's performance chart, you'll see 2024 returned 35.24%, and 2021 returned 27.64%, but 2022 dropped 12.69%. The ETF declined in one of 10 years shown. The Fund Facts Average Return section reveals that $1,000 invested since inception would have grown to $6,561 by April 2025. That's an annual compound return of 16.25%. That's impressive. But remember, past performance never guarantees future results. The fact sheet provides more detail. 1-year return of 20.73%, 3-year annualized return of 24.84%, and 10-year return of 15.39%. Notice how closely these match the benchmark S&P 500 index returns. That's exactly what you want from an index fund. Pay attention to the best and worst 3-month returns section. As shown, the best was 15.94%, and worst was negative 13.68%. This range reveals the potential volatility you might experience in the short term. Third, understand what you're actually buying. What does the ETF own? Looking at our example's fund facts, this ETF tracks the S&P 500 index, measuring large-cap U.S. stock returns. Examine the top 10 investments section carefully. As of April 2025, top holdings included Apple at 6.8%, Microsoft at 6.2%, Nvidia at 5.6%, Amazon at 3.7%, and Alphabet at 3.6%. These top 10 represent 35.6% of the total fund. The September fact sheet shows shifts with Nvidia at 8.0%, demonstrating how holdings change with market values over time. The fund facts show 505 total investments. That's incredible diversification across hundreds of America's largest companies in one purchase. Understanding your holdings is crucial for knowing how your investment behaves under different market conditions. Before we continue, let me know in the comments which ETF you're currently researching or already invested in. I'd love to hear from you. Fourth, and this is critical, understand the costs. Fees seem small, but compound dramatically over decades. Focus on the MER, the management expense ratio. As shown in our example's documentation, the MER is just 0.09%. That's only 90 cents per year for every $1,000 invested. The management fee is even lower at 0.08%. This is incredibly low compared to actively managed funds, often charging 2% or more. The fund facts clearly state, as of December 31st, 2024, the ETF expenses were 0.09% of its value. This equals 90 cents for every $1,000 invested. The manager has waived some expenses. Without waivers, the MER would be higher. There's also a trading expense ratio of 0.00%, meaning negligible trading costs. Why does this matter? A lower MER means more money stays invested and compounds over time. A 0.41% difference between two similar ETF could cost you thousands of dollars over 30 years. Fifth, examine sector allocation. This shows how your investment distributes across different industries. This reveals where your money works and your economic exposure. Looking at our example's investment mix, information technology comprises 30.4%. That's the largest allocation. Financials make up 14.4%, healthcare 10.8%, consumer discretionary 10.4%, and communication services 9.3%. The September fact sheet shows tech grew to 34.8%, reflecting recent tech surges. Why does this matter? If you already own tech stocks or tech-heavy funds, adding this ETF further concentrates your tech exposure. Conversely, if you want more tech exposure, this allocation might be perfect for your strategy. The sector breakdown reveals how economic changes impact your investment. Rising interest rates might benefit the financial sector while challenging utilities at 2.6% as shown. A tech correction would significantly impact this fund with 30 to 34% in technology. As shown in the fund facts, there's also exposure to industrials at 8.6%, consumer staples at 6.2%, energy at 3.2%, utilities at 2.6%, real estate at 2.2%, and materials at 2.0%. This diversification provides some balance, though it remains heavily tech-weighted. Where do you find all this information? You need to review two key documents, ETF facts and fund facts, also called the fact sheet. As shown in the examples throughout this video, ETF Facts provides regulatory information, including ticker symbol, exchange, currency, benchmark, and account eligibility. The Fund Facts provides detailed current information, including total net assets, performance metrics, top holdings, and sector weightings. ETF providers are required by law to make these documents freely available on their websites. Always download and read them carefully before investing your money. Let me wrap this up. Remember the 5 critical factors: risk and volatility, returns and performance, what the ETF invests in, MER and fees, and sector allocation. Do your homework every single time. Read the ETF facts and fund facts carefully. Understand exactly what you're buying, match the risk level with your personal tolerance. Check that fees are competitive, and ensure the sector allocation fits with your overall portfolio strategy. Investing in ETF can be an excellent way to build wealth over time, but only if you make informed decisions. I hope this guide helps you evaluate any ETF with confidence. If you found this video helpful, please hit that subscribe button and turn on notifications so you never miss our future videos on investing and personal finance. Thanks for watching.